Standards, I'm very pleased to welcome Sai Venkateshwaran, Partner and Head of Accounting Advisory Services at KPMG India, joining us in our Mumbai studios. Thank you very much for joining us this afternoon on NDTV Profit. I'm going to keep it very broad and basic first. Readiness of listed companies to transition to the Indian accounting standards in entirety. Based on your interaction with clients, what's the readiness meter looking like?
So if I look at companies that are moving in, I think the larger companies have, of course, started fairly early. I think a lot of them have spent most of the last year actually trying to get ready for this change. And as they have been completing their quarters in the financial year 15-16, I think they have also been kind of simultaneously preparing the information in accordance with Ind AS, and I think getting ready to report live from the current year onwards. But there are also a number of other companies, maybe beyond the first 100 or 200 companies, where that level of readiness is probably lower. A lot of them have probably woken up in the earlier part of this year to try and catch up with all of the restatement and transition requirements, and which is where I think SEBI also had to kind of step in, because what SEBI kind of mandated is that from June quarter onwards, that is this June onwards, when companies report their information, they will need to kind of provide the previous year comparatives in accordance with Ind AS. And that kind of came upon companies fairly late in the day to say that, okay, you have to restate the entire last year's information, including all of the quarters, into the new Ind AS standards, and then possibly get that audited, reviewed, etc. So that is where in the last 3-4 months, suddenly companies have felt that there was a lot of load on them. I think they were unable to kind of cope up with the extent of change, both from a reporting perspective as well as the number of additional disclosures that are required to be provided, etc. So I would say, yeah, a large number of Indian companies did wake up a little late to kind of deal with this transition, although we've known for a while that quarterly reporting will be mandated under Ind AS, and companies will need to kind of deal with this.
Right. A couple of things leading off from what you've just outlined. What is, I'm just going to revisit the task on hand for Indian companies. And I know some of this is theoretical, particularly to you, but for our viewers, it would be helpful to understand exactly what the task on hand is from this financial year in terms of complying with Indian accounting standards, Ind AS. And then, part two of the question is, what is the extent of reworking that companies have to do? You talked about the comparative numbers being a relatively onerous task for smaller companies.
Sure. So if I just take a step back to talk about the extent of this change and what is the kind of task at hand. So Indian accounting standards, or the Ind AS standards, essentially takes our Indian financial reporting framework to several miles ahead and kind of brings it on par with the best standards in the world, because our current set of standards that are there have not been revised or revisited for almost 15 years, and they've not kept pace with the current business trends, haven't kept pace with the current business models and all of that. So in that sense, there was a need to kind of do that catch up, and to that extent, I think it actually fills a lot of gaps in the existing accounting framework. Now, having said that, now when you look at these new standards and the way they kind of mandate accounting, it obviously brings it closer to the economic substance of business transactions, and that is what is meant to be reflected in financial statements going forward. The other thing is these set of standards also kind of require a significant amount of disclosures to be made, because Ind AS, unlike Indian GAAP, has a lot more of use of fair values. Whereas Indian GAAP is more historical cost oriented, and fair value information is more relevant for decision making, more relevant from an investor's perspective. And but the use of fair values also brings in a lot more subjectivity, a lot more of judgment, and therefore there's a significant amount of additional disclosures that are required to be made by companies as they kind of go through those. So a typical company's annual report or financial statements, which is maybe 20 or 30 pages, will now probably become 60 or 70 pages, and that's additional information is essentially a lot more meaningful information to an intelligent reader of financial statements and to the analyst community and all of that. So there is that lot more of information that's coming in. Third is in a number of areas, so for it, be it on accounting for acquisitions, be it on accounting for complex financial instruments, including derivatives, or on accounting for complex revenue arrangements, etc. So the existing standards did not have adequate guidance, whereas in the new standards, there's a lot more kind of economic substance-oriented, principles-based guidance that kind of comes in. So as companies look at every one of their complex arrangements and looks to apply these standards, obviously there is a lot of kind of work that goes in. And so therefore, from a company's perspective, this is certainly not a journey that can be completed in a matter of few weeks. It is essentially something that almost requires a year's effort, because they start by restating their April 1, 2015 numbers. So that is the date when they cut over from the old standard to the new. And so they restate their balance sheet at that point, then restate the one full year of comparative information in accordance with these new standards, and then start reporting from June 16 quarter in accordance with the new standards. Because it's very important to have that comparative information provided in accordance with Ind AS, because it's only then that an investor can compare information between both the periods on a like-for-like basis.
Absolutely.
Considering the extent of change that is involved here.
Right. I don't want to sound as if I'm searching for the negative here, but, is the 1 month sort of extra time given by SEBI do the job?
Well, not actually. So as we look at it, so SEBI is essentially given relaxations on 2-3 things. So the 1 month extension is one part of it, which is on the timelines. But based on my discussions of the number of companies, I think at least the larger companies are probably not going to go down that path and use that extra month. But the other important relaxations that SEBI is given is on the comparative information that needs to be provided, and on the audit or review requirements or the limited review requirements on that comparative information. So as companies have been dealing with this whole transition, I think the one thing that they realized was the challenge is actually the one is in putting together the information, and second is to get it audited or reviewed within the time frame that is available. And that's where they found that it was going to be challenging to first prepare all of this and to get it audited or reviewed. So what SEBI has done is, for the first 2 quarters, they have done away with the need to get your previous year's comparatives audited or reviewed by the auditors. So essentially, that is the relaxation that's probably most important. And also, SEBI has kind of also exempt companies from providing the March 16 comparatives, which is the annual information that is otherwise part of your quarterly results. So they have essentially made that also optional. So in a sense, when companies present their June 16 numbers, rather than a 5-column set of financials or what is typically presented, they will now have 2 columns, which is your June 15 and the June 16 quarters, both presented on an Ind AS basis, which is available to investors. So the March 16 numbers essentially kind of go out in this set of financials. And because SEBI has relaxed the review or the audit requirements, I think that gives companies that additional time to kind of deal with this change. But I don't think companies are really going out to change their board meeting dates and kind of make full use of this additional month that's provided. And the other thing to keep in mind is that when SEBI is obviously mandating some of these things, it's coming out of the baseline requirement, which applies to the hundreds or thousands of companies that are impacted by these set of standards. But I think the larger companies, the ones that are probably impacted to a greater extent, I think they will still stick to their initial timelines. And they will also look to provide more information than what has been mandated by SEBI, because they are going to look at what is the relevant information that I need to provide to my investors. How do I kind of differentiate between business performance versus the change in numbers impacted by this accounting change? And I think that is what they will want to communicate more effectively with investors. So every company will need to kind of come out with their own investor communication strategy and see what more than the minimum mandatory information are they going to actually put out to investors to make sure that the investors fully appreciate the extent of the change, and if there is a business impact and an accounting impact which are kind of offsetting each other, how do they kind of fully appreciate the business impacts vis-a-vis the accounting impacts?
Okay, so very important to note that actually the relief comes in, the dilution of the audit requirements of the comparative numbers more than the 1 month extension or 1 month extra time that has been offered, and a very important to also absorb that the large companies were likely to be adequately prepared. This is not something that they've woken up to in the last few weeks or months. This would have been a massive, well thought out exercise, but perhaps some relief for the smaller companies, definitely. If I can, with your permission, just get some thoughts on a slightly different subject, which is that the government has formed a panel to examine the feasibility of a new financial year. And this is going to be headed by former Chief Economic Advisor Shankaracharya. India currently, follows the April to March financial year. And I thought I'd use your accounting wisdom and experience to get your thoughts on this. We're talking about the government of India, but this is a thought process that companies also go through when they're looking at January to December versus April to March. The bulk, I guess, is what, April to March?
There are two things involved here. So one is the financial reporting requirements and the year followed for financial reporting and the year followed for tax purposes. So for tax purposes, I think India has always had a kind of a April to March kind of a year end, which has always been kind of mandated from a income tax perspective. But on the financial reporting perspective, companies have followed historically different year ends. Some of them have followed the calendar year end, so especially Indian subsidiaries of multinational corporations where their parent company has a calendar year being followed. I think the Indian subsidiaries have kind of done that as well. And a number of other companies have used different kind of year ends. There was also a point at which where companies used to frequently change their year ends to suit their own requirements, so at times extending it to 15 months, at times bringing it down to a 9 months extra to meet various objectives. So to curb away with a lot of this, in some sense, abuses that are happening of that flexibility, the Companies Act 2013 did bring in a uniform year, which was April to March for financial reporting purposes as well. So this is in effect the second year when that uniform year is actually in play. And of course, they did provide a little bit of leeway, saying that if you are a subsidiary of a foreign multinational and you have reporting requirements to follow a different year, and then necessarily you make an application to the National Company Law Tribunal or the Company Law Board and get a specific exemption. But otherwise, today all Indian companies are now required to follow the April to March year for financial reporting purposes as well, and that itself is a new change that has kind of come through. So to bring in that uniformity. So right now, I think the statutory financial reporting and the tax reporting are aligned in the sense we have a common April to March year. I think that's probably the first step. Now, of course, the second step to be looked at is April to March the ideal time, or should we be looking at a calendar year or some other year for that matter?
Right.
And I think that is probably something that requires a little bit more of deliberation and thought as to what should be the reasons for that change and what's probably the best year to follow.
Right. Well, appreciate your thoughts on that. Sai Venkateshwaran, Partner and Head of Accounting Advisory Services, KPMG India. Good talking to you and understanding just how relevant or not the relief offered by the Securities and Exchange Board of India in the context of compliance with Ind AS is. Good to get your perspective. Thanks very much once again.
Thank you.